perception that the stock markets have given a standing ovation to the budget 21-22. Now there are some broad views on the budget. I think it is still quite unclear to many of us as to what are the key points in the budget and what is it that is exciting the market. And at the same time, there is also another view which hasn't come so much in the papers, that the euphoria that you see in the market is more linked to the corporates, whereas the real sector, the employees, the migrant labor, these are some of the sectors that have not been touched and therefore not addressed. So I'm sure we will hear all of that and explanations for why maybe one section of the market and the economy is very excited about the budget, and why maybe there are still concerns on what has not been done or what could have been done. To open the session, let me introduce and invite Dr. Keiretsu Bhattacharya. He has a very long career, very interesting career, and I want to share just some points of that. I won't get the time to go through all of that. In his current capacity as the CEO of 01 Microsystems, he, in a way, is a startup entrepreneur. But before that, he was a partner with KPMG India. He's also the president of the Center for Digital Economy Policy Research, which is a think tank. He's been very active in the academic world. He's a member of the Senate, Academic Senate of IIT Raipur. He is also a director on IIM Calcutta Innovation Park, and he is an adjunct professor at IIT Delhi. As I said, he was a former partner with KPMG India. He was also the country director for Sun Microsystems in India. Highly accomplished educationally, he did his BTech from IIT Kanpur, his MBA from IIM Calcutta, and his PhD from IIT Delhi. In every sense, a completely Indian-made profession, I would say, because typically for these kind of people, you would also see some of the other universities outside mentioned, but in every sense, India-made entrepreneur, consultant, professional, and academic. Over to you, Dr. Keiretsu. Take us through what you saw in the budget and why is the market getting excited, and most importantly, what is in it in the budget for the startup and the SME sector, because I was reading in the papers today, for example, that despite 2020 being the pandemic year and the year of the lockdown, startups actually increased hiring by 35%. And I think now as a country, we've come to realize that that is the only one sector where really jobs are getting created. So what is in it in the budget for the startup sector, and what does it say for the overall economy? Over to you.
Sure. Thank you. Thanks, Denny, and thanks for that embarrassing introduction as a made in India person. Although happy to have that on my CV. And good morning, everyone. So Denny kind of drafted me to have this onerous task of providing an overview of this budget without sounding dry. And my guess is such impossible tasks and goals should be reserved only for startups. While wearing the hat of an economist, I still have to be a little dry, and I'll try and see if I can translate some of the things to make it more relevant. So as we see the light at the end of the tunnel of a COVID-affected year with demands coming back to the market, we seem to have got a very well-rounded budget, which is largely being appreciated by the industry. Most of the common people are seeming to like it, except for the fact that the taxpayers haven't got have a tax break. And the stock market, as Denny mentioned, is also cheering it. So it seems to be a pretty well-rounded budget. The budget has come at a very challenging time. And I'm not going to talk about the economic pressures because of COVID, which is something that everybody is aware of. But it's important to remember that the economic challenges we had are coming from pre-COVID times. In the pre-COVID previous financial year of 1920, the GDP growth had already gone down to 4%, which is very low for a developing country like India. And the fiscal deficit had already breached from a target 3.2% to what we really saw at the end of the year to be 4.6%. So there's nothing sacrosanct left about the fiscal deficit even before we had the COVID breathing down our neck. So we were already stressed before COVID hit us. And in the current year, 2021, the revised estimates already 29% lower than the budget estimates. Imagine your revenues going down by 30%, all your that has exactly what has happened. So the budgeted receipts was 22 lakh crore with around roughly 2 lakh crore that was expected to come from disinvestments. And that disinvestment never happened last year for the obvious reason that the market was down. I don't think any of us would have liked it if our taxpayer paid assets were sold off at a much lower cost. And therefore, there was no money coming in from the disinvestments. And against this 22 lakh crores of budgeted receipts, so the earnings of the government, so to say, the expenditure was budgeted at 30 lakh crore. And on top of it, there was a unbudgeted fiscal stimulus of 21 lakh crore that the government had announced for managing COVID. Plus, in addition, there was a sudden pressure for defense expenditure given the border challenges. So clearly, nominally, there was a hole of around 20 lakh crore, and hence the fiscal deficit is expected to shoot up to 9.5% of the GDP. And that was, that has to be the case. There is no other way that we can manage the situation without really funding it through deficit. So the budget proposes to recalibrate the fiscal deficit targets and is now looking at around 6.8% of GDP to be the fiscal deficit for the coming year 21-22 with a gross expenditure of about 34.83 lakhs. By the way, this 34.83 lakhs expenditure is roughly the same as what we will end up spending in this year 2021 that we're completing. So it's kind of a flat growth in that sense in terms of expenditure. And what the budget therefore says is that, well, we will spend 6.8% through fiscal deficit in next year, but by 2026, the fiscal deficit will come down to 4.5%. And this is necessary. There's nothing to be alarmed about it. This is something that we need to do. There was nothing sacrosanct about fiscal deficit in that sense, especially for a growing economy. But for a startup, we need to interpret fiscal deficit as an important indicator of the level of inflation we will have, and hence plan our budgets accordingly. So, in certain startups, if your inputs are certain kinds of commodities, just make sure that you have budgeted for inflation of those commodities and the prices going up. And therefore, will make sure your output pricing is accordingly done, because clearly there will be quite some inflation happening in the coming year. Also, the deficit financing is not sufficient, and serious non-tax revenue sources are also needed to be tapped, which is obvious, because if your revenues are lower, your expenditure is higher, you need to get revenues from somewhere else. You can go ahead and print money, but that's not the wisest thing to do. So what we see the budget is proposing is a very aggressive asset monetization. And the government had been toying around with asset monetization. We were working on it from year 2016. The first road asset monetization happened about 2 years back with an Australian bank picking up one of the road assets at $2 billion, which was very, very good money coming in. So therefore, just a quick note on what is asset monetization, because again, we keep throwing terms without explaining. It's very simple. You have lots of assets lying around. You've got roads lying around, railways lying around, railway stations lying around, power cables lying around. Can we go ahead and just sell it to the private sector and let them run it? And that's what asset monetization is. So the asset monetization has now been extended to power lines, gas pipelines, railway assets, even the dedicated freight corridor, and of course the roadways. So there is a very aggressive asset monetization, and that's where this term is coming out, that it's looked like a Thatcheristic budget, because that's what Margaret Thatcher did, where she aggressively privatized most of the assets that the government had. And that obviously helps as long as we use that money to recycle it into more assets. So if we're able to execute asset monetization, then we would be able to create a neat model of government investing into assets at a lower risk and hence lowered costs, and then selling the assets and use the proceeds to build more infrastructure, which is what we all need, which is what the country needs. And it would be a very commendable virtuous cycle. So the government creates assets at a low cost, sells it, builds more assets, and then sells it again. In fact, it reminds me of the Israeli model, where they actually encourage startups to be created just to be sold to US firms. And for some time, there was some debate in Israel that why are we giving tax breaks for these startups? Because they eventually get sold to US companies or European companies. And then they came to peace saying, well, we will go ahead and build more startups, which will disrupt the previous startups that we have created. And therefore, that itself is an economic model in Israel. And I guess in a way, we are mimicking that by continuously creating assets and selling that. In fact, coming back to the expenditure, the budget proposes a very sharp increase in capital expenditure. It proposes to actually invest 5.54 lakh crore from the previous year's 4.39 lakh crore. It's a significant jump. And therefore, there's a lot of money that will be pumped into economic corridors, into road infrastructure, river ports. In fact, I don't see any startups in the river port area, and not even in the coastal shipping area. So we talk about deep shipping, which is obviously something that the big boys will be focused on. But things like river infrastructure, river ports, or small little linkages, if you look at a comparison, 30% of goods are transported in Europe over river. In case of India, it's less than 5%. And at some point in time, it was over 90% of the goods being transported over river in India. I'll skip the details of that, but essentially I see a huge opportunity over there. And in addition, disinvestments of the PSU is targeted to come in to bring in about 1.75 lakh crore, which should be doable in the current market conditions, given that the stock market is cheering everything that we're doing. So we can dump some of the government PSUs into the stock market and make some money out of it. Also, my quick back of the envelope calculations is that the COVID industry itself will be a 1 lakh crore industry, which is simply a simple calculation of 1,000 rupees per person into number of people we have, and the expenditure is on your sanitizers and your masks, in your COVID vaccine, and in hospital treatment, which will actually pump in a lot of money into the economy, create jobs, and will be boosting the economy. In fact, I saw a lot of startups pivoting into a COVID-ish kind of a solution. Some people are giving visitor management system which tracks who is coming in, automatic checking of temperature while people are sitting in a car. And those are very complex technological problems to be solved. And I saw a lot of startups getting into it. And I guess there is a large industry that got created around it. A lot of it will continue post-COVID also, because the requirements stay the same. For example, work from home will become a new normal with or without COVID. And which is why what Danny was talking about was a lot of startups hiring people. Startups could hire people because location was no more important. So you could really go out and hire people from wherever they were. However, the other point that I see from the budget is the COVID cess on petrol and diesel and agri-cess, which will have significant inflationary pressures on food. In fact, even this year, the number one contributor to inflation was actually food. So startups who are dependent on agri input should brace themselves for increase in input costs, specifically, as I said, for agriculture, but also for every other commodity in that sense. Among the top 13 ministries with the highest allocations, the highest annual increase over 2019-20 was for Jal Shakti Ministry. And that kind of links back to what I was talking about in terms of river ports, but Jal Shakti is not about transportation. It's more about water. And therefore, entities which are into civic technologies, civic tech, I think they should be finding a lot of opportunities flowing from the government expenditure. The number 2 increase in budgets is for Ministry of Consumer Affairs, Food and Public Distribution. And the number 3 is Ministry of Communications with a 131% increase. Last year, if you remember, they had a 125% increase in the budget allocation. So clearly, digital continues to be a focus of the government, with 2 consecutive years of massive allocation to Ministry of Communications. In addition, there is significant incentives for R&D and the provisions for thrust on space industry, which would help India get a fair share of the global market. And therefore, a lot of these startups which are in space tech should be able to get an impetus from these expenditures from the government. The budget is also talking about support for the development of a world-class fintech hub at GIFT City. But this will be specifically of interest to those fintechs who are involved in cross-border financial transactions. I would really encourage fintechs to keep an eye on these developments and possibly try and see if they can get themselves have an office in the GIFT City. There'll be a lot of benefits that'll be coming out of it. There are also specific provisions for startups to cheer them up further. There is an extension on tax incentives by a year up to the end of fiscal 2021 for profits of startups. I know some of the startups are actually completed their 10 years, so tough luck for them. And also there is a break on investing capital gains in startups, which is essentially Section 80 ISE of Companies Act 2013. The startup should not have a turnover of over 100 CR is another limitation that has been put in, which I guess is a pretty fair limitation. Also, businesses which carry 95% of the transactions digitally and whose turnover is less than 5 crore rupees are exempted from keeping audited accounts. The threshold will be further increased to 10 crore. This is great news for at least my startup because almost everything is digital. But I doubt my investors will agree to not having an audited accounts. So I still need to maintain that. In addition, the Companies Act 2013 will be amended to revise the definition of small companies by increasing threshold for paid up capital from 50 lakh to 2 lakh crore to 2 crore, and the annual turnover from 2 crore to 20 crore. So startups can continue to have the benefits of a small company as they grow. And I think this is quite aligned to the new aspects of the economy where 20 crore is not really a very large amount. The budget also proposes to incentivize incorporation of one-person companies, a move which will really benefit startups and innovators. This move will, I know so many startups who have to put their spouses in as the second, shareholder, and it just increases complexity. So the move will allow the one-person companies to grow without restriction on paid-up capital and any restriction on turnover, allowing conversion into any other type of company at any time, reducing the residency limit for an Indian citizen to set up a one-person company. Earlier it was 182 days, now it's 120 days. And as an NRI, as a non-resident Indian, you can also incorporate one-person companies in India. So that's a lot of flexibility. I see a lot of money flowing in through this route because of this flexibility being brought in. On labor and employment, because many of the startups are actually growing and have more than 10 people, more than 20 people, and so on. A portal has been proposed to be created to collect information on gig workers and construction workers, among others, to help frame schemes on housing, health, insurance, and so on and so forth, migrant, unorganized workers. And these are the people who have always been left out. And with startups coming in, we hire people who are not on our rolls, who go on onboard merchants, they go on and onboard our users and so on and so forth, and they're never covered. So this is a scheme which allows such workers to get covered. And I also see a lot of opportunities of startups to be intermediaries in this particular ecosystem that is getting created around this portal. So there's a lot of opportunities out there. If I remember correctly, the Apprenticeship Act will also be amended to enhance apprenticeship opportunities. Again, this is an opportunity for startups. You can leverage the Apprenticeship Act to actually get high quality apprentices for your startups, and it's a cheap way to actually grow, actually inexpensive way to grow. Cheap has a different connotation. In the science and technology front, it has been proposed to launch the Deep Ocean mission, covering survey, exploration, and projects for conservation of biodiversity. Again, there are a lot of young folks who are interested in conserving the ecosystem. They are into deep tech. There will be a lot of opportunities over here for such startups. They can go into some very exciting startups involving the deep ocean. In water and sanitation, the Jal Jeevan Mission Urban will be implemented to enable universal water supply and liquid waste. And as I mentioned earlier, there will be a lot of opportunities for civic tech, for cleaning up in terms of single-use plastic, for reducing the air pollution. And I think there will be a lot of energy out there for civic techs. It'll be a great opportunity to go and leverage these spaces that open up. By the way, these steps are in addition to previous startup-focused measures announced by the government, including the broadening of startups definition, simplifying regulations, providing income tax exemptions, and setting up of a 10,000 crore fund of funds run by SIDBI. So all of that was already done. The government also approved the Startup India Seed Fund with a corpus of 945 crore. It is aimed to providing financial assistance to startups for proof of concepts, prototype development, product trials, market entry, and commercialization. So please go ahead and leverage this fund that has been created. I'll end up my budget review with an interesting factoid. As of the last week of December, there were over 41,000 government-recognized startups in India. And of this, over 39,000 startups accounted for almost 500,000 jobs in this country. Again, amplifying what Danny said, that most of the hirings were actually happening from startups in the last year. With as many as 38 unicorns, and 38 unicorns with the rough calculation is $38 billion straight away. I'm sure it's more than that. With 12 of them coming up last year. So we have that many unicorns in this country. India's startup ecosystem is currently the world's third largest, and I'm pretty sure this year's budget will further accelerate the startup ecosystem in India. Thank you.
So thank you, Dr. Jayajit, for that very comprehensive, overview of the budget, especially what it's been doing for the startups space, not just the budget, but even the measures prior to that. Before we move to the panel, let me introduce the other panelists. Mr. Shenoy is the Cfo of Mtr Foods, which is a 100% owned subsidiary of Norwegian company Orkla. MTR was taken over by Orkla, and now they are in the middle of another acquisition. They have just announced the acquisition of Eastern Foods, which kind of completes their footprint in the south, but I'm sure you would still be looking at companies in the north to grow into an overall, all India player. Mr. Shenoy is both a chartered accountant and a cost accountant by profession. Mr. Gopal Rao retired as the Chief Commissioner of Income Tax, Mumbai, after spending about 35 years in the Income Tax Department. He is currently the Director of Tax Advisory with Fox Mandal. Mr. Sandeep Mukherjee is again a chartered accountant by profession. More than 30 years of experience in the industry, out of which about 27, 28 years were with some of the big four, PwC, Deloitte, Anderson, and the like. He's also worked with large Indian corporates both in India and abroad. And finally, Mr. Pramod Bandia, who's the Director of Indirect Taxes with Fox Mandal, was also with one of the big four, having spent about 10 years, if I got that right, with PwC. But in all, more than 20 years of experience in the tax space, again, both in India and abroad. So that's a panel. Before we get to the question, let me just kind of maybe set the context for what we are kind of looking to hear from you. Typically, when one looks at any budget, there are 3 or 4 major aspects that you would look at. One is the overall direction the budget is setting. Where is the country going as an entity? 2, what are the priorities for this year? Obviously, when you go in a particular direction, there are so many things that you need to do, and all of that can't be done in one go. So you have to pick the priorities. What are the major priorities that are picked for this year? And in fact, I was reading an interview with Finance Minister in the Economic Times today, and she was mentioning infrastructure, health, and agriculture are the big ticket areas for this year. But we would like to hear from you if these are the right priorities. Are there other things that need to have been addressed? And number 3, once having picked the priorities, what is the plan of action to execute what we are going to do? And finally, what is the plan for resource mobilization? And it's very typical of even running a company. What do you want to do? How are you going to do it? How are you going to find the resources? Whether it's a startup, an established company, or a government, it's the same process. So if each of you can take about 3 minutes each and give an overview of where the budget is taking us in terms of each of these 4 different aspects, that would set the stage, and then we could take some questions from the audience and from among ourselves. Can I request Mr. Gopal Rao to go first, and then maybe I can come to you, Mr. Shenoy, and the others one by one after that. Mr. Rao.
So good morning, all the panelists and Mr. Dini for giving the opportunity. And as you know, this year's budget is a very, very important budget. And Mr. Bhattacharya has already talked about the priorities of the budget. He has specified some areas also in this regard. And he also mentioned about the current fiscal deficit, very huge. As against 3.2, which we wanted to maintain, but it has crossed almost to 10%. The coming year, it is fixed at 6.7%, the fiscal deficit. Particularly, there is a Herculean task on the tax departments, particularly the revenue departments. As the taxman, I always look at the perspective of the tax point of view. And there is a lot of pressure, going to be pressure on the revenue mobilization and the tax collections. In fact, in 2018-19, Income Tax Department, the direct taxes collected around 12 lakh crores. That has come down to 8 lakh crores this year, but the current year, that is 2020-21. And now the target fixed for 21-22 is around 12 lakh crores. I mean, there is a big task, big challenge for the tax department. Similarly, for the indirect taxes also, there is a big task for the revenue mobilization. And the biggest relief from the budget is to maintain stability. There is no tax increase. And there are certain very welcoming features here in this budget. And industry has given thumbs up, and stock markets have given a standing ovation, as told by Mr. Danny. And things are, I mean, generally the budget is received very positively, and a lot of thrust on the infrastructure and agriculture and human capital formation and welfare activities, of course. And the present discussion mostly on startups, and there are certain provisions regarding startups, and we will discuss about those things in the question and answer. And Mr. Sandeep also will outline what are the incentives provided for these startups. Of course, Mr. Bhattacharya slightly touched these aspects. And I am very confident the present budget is a growth-oriented budget. And if implemented, if the allocations made are spent and executed all the projects, I think the expected growth rate of 11% will not be a difficult thing for the government of India. And with these opening remarks, I leave it to the other panelists.
Thank you, Mr. Rao. Mr. Ganesh, as I mentioned, you had done one acquisition of the overall MTR company. Now you're going through another one, and that brings us to an interesting point, because for a number of startups, the first source of revenue is individuals, some of the smaller funds. But these are also investors who are looking for exits and returns, and that will only happen when these startups are either able to raise much larger amounts of money from strategic investors like, for example, MTR, or they are able to go through, acquisitions, mergers in a very seamless way. Has the budget made that process any better, or what is it that needs to be done by the country and the government to make sure that the startups with new ideas not only get the early funding, but also get the opportunity to provide some exits to those early funders and can continuously, consistently raise money?
Yeah, thank you, Denny, and good morning to all my fellow panelists as well as to the participants on this in this event. I think the specific question is about startups. So let me first respond on a broad macro basis. I think the startup environment, I think, is getting an overall thumbs up from the government, because it feeds into the overall, whether it is the Atmanirbhar platform, it need not, startups need not just be in the high tech. We could even look at agri-process companies and a whole lot of startup businesses that can be set up right across the value chain in the country. And I would say some of the relaxations in the one-person company, small company, all these are steps in the same direction. And while all of us can expect, even more encouraging incentives and steps from the government, my sense is, I think startups will always continue to be value creators. And I think this recognition has always been at the center of attention from the government. And that is why you see a lot of these relaxations being introduced, which Dr. Jaijit and Mr. Rao spoke about. And I would also say that as far as funding is concerned, startups will continue to be given the priority from the private sector. And there are some 2 or 3 dimensions out here. Many groups have set up seed funds, startup funds, because all of them, especially in the banking sector, even we in MTR, we have set up a seed fund and a startup fund. why these funds are set up is to really get the benefit of the agility and the new ideation, which some of us larger companies cannot really participate in. And some of these small companies which come with brilliant ideas need to be nurtured. And therefore, I think the startup culture, which has, in a manner of speaking, got seeded in the last few years, I think will continue to gather momentum. And all the relaxations, the incentives that have been provided, I think will probably continue. And I would also end, while there could be a lot of questions, especially around goodwill and issues like that, which we will pick up in the Q&A section, I would say two things. The government has laid a very strong ecosystem. They have laid a very strong, I would say, enabling environment to really accelerate the startup culture in the country. And I think it is now, for the private sector, for the startup community itself, to really leverage this enabling environment. And of course, we need to engage with the government to really look at certain specific issues that could be hurdles in developing the startup culture further. But I guess some steps that the government takes, I think, should also be followed by some steps from the private sector. And because it should really be a partnership to really develop this culture. And, India is number 3 now. We could possibly go to number 1, if this partnership really develops further. So I'll stop here and let's hear the rest of the panelists, and we can come to the Q&A for more specific questions on this.
Thank you. Thank you, Mr. Shenoy. And that, in fact, reminds me, before I go to Mr. Mukherjee, the participants, if you have questions on what you heard and what you will be hearing, please type it in as they come to mind, so that we can pick those questions after we are done with the introductory remarks. And you can do that into the Q&A window. We will be monitoring that to pick up questions. So please do that as you are listening. So, Mr. Mukherjee, let me now come to you and more specifically ask you, because you've been dealing both with international taxes and direct taxes. While there are some very small measures like a 1-year extension of a tax holiday and a 1-year extension of the capital gains tax provision, there was a lot of talk prior to the budget that there could be much more big ticket announcements in terms of the startup sector. Were you disappointed with what came in the budget, or did it in some way indirectly still do what it was supposed to do?
Sure. Thanks, Danny, and good morning to all my fellow participants and all my fellow panelists. So Danny, your question specifically, on the expectations that we had from this budget. To be very honest, the expectations actually were that the government, given the kind of situation that we were in, could probably resort to further harsh measures of taxation, which I think was what everybody was talking about, either the imposition of a new cess or new wealth tax or inheritance tax, or the taxation of high net worth individuals. So in a way, those fears were allayed, and I would think that's a big relief. As far as overall the tax community is concerned, there were no new taxes. As far as surprises are concerned, those were also not there in this budget in terms of any measures which were considered to be negative or would pinch the pocket further to the common man. So given that those measures were not taken, overall the budget I think was welcomed by all taxpayers. Coming to the startup industry and the startup sector, well, this is an industry which I think is a sunrise industry for the country, and there is a lot which needs to be done. As we know, the MSME sector, accounts for nearly 28% of the India's GDP, and close to 111 million people are employed in this sector, and about 40% of the merchant exports are accounted to the MSME. So given these kind of statistics, the MSME sector, the startup sector, the small and medium enterprises, the businessmen are generally the so-called the growth engine of the economy. So that's the way to go. And there are some measures. I wouldn't say there are none. There are some measures, especially the ones which are, our other panelists talked about. Some of the measures which we'll discuss it in more detail during the presentation. Given the focus on small companies, focus on the startup, especially the IFSC, the Gift City in Gujarat. That's, I think, a focus, a thrust area, and I would think we might want to see more such gift cities in the future in other states, and that's probably something which the government will be doing. Definitely, there is a lot of impetus given to small investors, foreign investors, to come and set up their financial services centers in the Gift City, also to sovereign funds and pension funds. So these are some measures, some relaxations which have happened, by increasing the threshold limit for tax audits for small enterprises and small businesses. I think overall there are some measures, but this budget probably was not the budget which was only focused on the startup sector or only one sector. There were so many things to be addressed. Overall, I think from a tax administration perspective, a lot has already been done in the last 6 years of this government, and we have seen many more things which have been introduced in this budget, especially the digital transformation that is happening within the revenue, and we will talk a little bit more about it. I think that's a welcome step, and these are indirectly going to help the startup industry, because all of these industries are involved in providing the digital kind of benefits and the mechanisms for the kind of transformation that the country is going through. So I think directly, yes, some measures are there. Indirectly, a lot of measures are definitely there, and I'm sure it's an encouragement for each and every startup in any industry. I'll stop here. Thanks.
Thank you. Thank you. You, in fact, touched on one point I was anyway planning to come to, the fact that maybe the market and people who are expecting much worse in terms of taxation. So the overall euphoria in the market would also be, just a sigh of relief that it could have been much worse, but it hasn't really gone there. Otherwise, how would you take something like, the provision to open tax filings is now only 3 years as opposed to 6 as a positive thing. For anyone who is honestly paying tax, it doesn't mean anything at all, right? So that only means something for somebody who has something to fear, and yet that was shown as a big relief to taxpayers, which one fails to understand. The other thing, of course, is Mr. Mandya, as I'm coming to you, many of the speakers touched on the resource mobilization plans, and Dr. Bhattacharya talked about 1.75 lakh crores as the disinvestment target for next year. Now, if you look at the current year, the target was, I think, 2.1 lakh crores, and what has been achieved is a little less than just 20,000 crores. Of course, given that it was a pandemic year, the markets were not that great. But then if you look at the markets, it's only the early part of the lockdown when the markets were not doing well. After that, actually, the markets were really doing well, even though many of us felt it was irrational exuberance, but it still was exuberant. So given this year's track record and given the track record in the previous years, how do you see next year's privatization target of 1.75 crores and the rest of the resource mobilization plans? Because certainly there is a big plan to spend on infrastructure, on health, on agriculture. But at the end of the day, it's not just about the announcements, it's also about the ability to execute. So where do you see us as a country at the end of next year in terms of actual execution of both resource mobilization and the spending targets? You need to unmute yourself. Yeah.
Thanks, Danny. Thanks for this opportunity. And good morning to all the panelists and to my participants. Yes, I think, in my view, of course, this budget presentations was very positive. Overall, I think no negative news is a good news, as we all see. And we were all prepared that, this budget will be more growth oriented. The focus will be more on the agriculture, on the infrastructure, on the education, on the health. So I think that is where I think she has delivered fairly, and she has a huge plan in terms of investing in each of these sectors. Revenue mobilizations is definitely very important, because I guess since there has been no increase in the tax rates, there is no additional tax. I think a lot more depends on how she executes on the disinvestment of the PSUs and non-core PSUs, what she has actually lined up. Last year was difficult since she could not really, do the disinvestment for varied reasons, because of the market were down and the valuation was not appropriate for disinvestments, and people were not coming upfront to carry out this. I think this year she has going to definitely do a significant disinvestment. BPCL and others are already lined up. From a investment in agriculture sector standpoint, I think what she has done, she has levied another cess, which is Agriculture Infrastructure and Development cess. Of course, she has reduced the equivalent customs duty on the specified products on which the agriculture cess would be levied, so that the impact is not much on the consumer, but a portion of the customs duty has been earmarked for investment in agriculture sector. And I think the reason was, again, if the basic customs duties again has to be shared with the state government, whereas this says if we can replace that with says that entire kitty is available to the central government to spend on agriculture. I think this was a smart move, though of course it will raise several concerns on compliance. Additional compliance will be there with regard to the importer. As we speak, I think the imports are being stuck today because the system is not ready to introduce this new tax, which has been levied immediately. And as far as indirect tax is concerned, I guess there has been good increase in the revenue. As we have seen last month, we had a record GST collection of 1.2 lakh crores. And we expect that to continue as we go forward as well. I think this is what 4 or 5 consequent months where we have crossed 1 lakh crore of revenue. I think GST is definitely going to give that boost. Of course, last year the revenue was down significantly, but this year hopefully it will be recovered. So I think from tax, the good part is that there has been no increase in tax, which is very good news. And I'm sure the disinvestments, the revenue augmentation, and several other measures that the borrowing which she will do will definitely help in building the sectors which she has identified. I think overall it's a very positive from every point of view. So I give thumbs up to this particular budget. That's my views.
Thank you. Thank you very much. There are already some questions coming in from the audience. Let me take them one by one. The first is from Chandas. Chand was the former CEO of ITC Education and ITC Bhadrachalam. He's asking, what is the status of listing SMEs on the stock exchange? Is there anything to create a route to IPO for SMEs and startups? I don't know who would like to take the question. It's open to all. Who would like to go take it?
Yeah, I could possibly chip in here. I think, we always had access to what we call the alternate investment markets, while I think, most of these markets were really overseas. I think the point is absolutely valid that if we need to really expand the sources of finance for startups and SMEs, I think the more positive step could be to actually set up some kind of aim, what we call the alternate investment markets, possibly in India. I think that's something which I think the industry could possibly represent to the government, because the ecosystem is very strong now, well developed, and that could be a suggestion which we could take forward.
Thank you. And as of now, the government doesn't indicate that it is happening, right? I mean, it's still work in progress.
Yeah, I think so.
Thank you. Again, Dr. Jayajit talked about this one-person company and how the government has now made it easy for individuals, entrepreneurs particularly, to start a company. What is the significance of that move? Do you see that as a big step, or is it just one of the many things that are being done? Maybe, Mr. Rao, if I can come to you, since you've been in the tax space, how is that relevant, and how will it make it easy for companies?
Yeah, it is really a big step, welcome step. In fact, in the budget, the time residency period is also reduced from 180 days to 120 days. And because a lot of interest shown by the NRIs also, to invest in India. And it allows a lot of investment opportunity in India by these one-person companies. And the budget also provided these companies can convert into LLP or full level company and all. There is a provision for conversion. So these decisions are very important for attracting investment to India. Not only Indians and by NRIs also. It is a welcome step, and not one in many steps, but it is really a good step. That's my personal view.
Thank you. Thank you. We can take a couple of more questions. Some of the panelists have a hard stop in another 5 or so minutes. Another question was from Srikant Ravindranath. It is on labor laws related changes made. The question says all workers are to come under the ambit of the Employee State Insurance Corporation. Minimum wages will apply to all categories of workers. What is the impact on cost and compliance of businesses that is at large where engagement on contract basis was the norm? Is impact large now with this change? Again, I think I will come to the tax specialist, either Mr. Mukherjee or Mr. Bhantia, to take this question and answer.
Yeah, although it's more a labor law issue, my perspective is that, see, I think the government is trying to clean up a lot of things. And it is not just when it comes to these kind of changes. There are so many changes which we find which have been introduced to try and clean up some of the systems, to make it a little bit more structured and more organized. So, for example, the issue also of the one-person company. I think this will help close to 200 plus businesses to move from their current structures to a one-person company. That will definitely be more structured. It will be easy to form. It will be easy to manage. Similarly, when it comes to labor laws, or for that matter, any new laws which have been introduced, yes, on first blush, it might seem that, this is too much of compliance, which is being thrust on the employers. But I think it will help in managing the affairs which were so long and so, till such time we were not probably being able to capture the data the way in which it should have been. It will also probably help in better incentives being given to the organized workers, the labor class, and they can probably be able to demand a better compensation in this kind of a setup. At the end of the day, the responsibility does lie on the employers to ensure that they provide the right kind of incentives, right kind of compliances. So these laws are only meant to make things more organized and more structured. And I think it will go a long way. The compliance is just a small kind of a burden, which I hope and I'm sure the industry will be able to accept it going forward.
Thank you. There is another question which is a little general in nature, but I think it's an important question too. I don't know who's asking because the name is not shown here. What should Indian tech companies keep in mind before they go for an IPO? I think maybe Dr. Jayajit, you could address this because I'm sure as an entrepreneur, going for an IPO also would be at the back of your mind, at least for the long term.
I think that's nothing related to the budget in that sense. So
That's right.
That's a generic question, with the generic answer being that make sure that you have a profitable venture, you have a scalable venture.
Can you be a little louder?
Sorry?
Can you be a little louder? I mean,
Can you hear me now?
Yeah.
Yeah, I was saying that one needs to make sure that you have a profitable venture. It's a scalable venture, and it's focused on what it's supposed to execute. I think those are three key points, because that's what an investor will be looking at. That will their investment lead to a continuous dividend coming in, and that dividend determines the pricing in the share market. And therefore, it's a very simple formula in that sense. Just make sure that you have a profitable venture in place.
In fact, I have a follow-on question on that. I mean, again, it's not related to the budget, but one of the things we've seen in companies from overseas, that we look at for funding, startup companies, particularly from the US. In sectors like biotech, for example, in the US, there are cases of companies going for an IPO even without the product being in the market, just when they have an IP. It is possible for companies. And initially, when they came and said that we will do an IPO in the next 2 years, we were surprised because the plan doesn't even show a product in the market in 2 years. But that does happen in the US. Is something like that foreseeable in the Indian market? Because that will open up a whole new opportunity, because the whole idea of a startup and the new economy is, at least as we see, is not immediately about making profits, but about market share and eyeballs and DMEs and all of that.
I think we're a little far away from that in the Indian market, simply because we don't have the depth and the maturity from the investors' perspective, specifically the individual investors. Of course, if there are institutional investors, they can gauge the risk, they can price the risk, and therefore they can invest appropriately. We do have cases in India where entities which are actually are seriously loss-making are going for an IPO because they are able to paint a picture that eventually they will be able to monetize it. But there are very few such cases in India. In US, we do have cases where, as you rightly said, a single patent has led to, I know of a company with $2 billion of valuation in the stock market. And as you rightly said, they have still not put up their factory. And they're still negotiating the deals of putting up the factory to monetize the IP. But if there is a clear path, then and there is a maturity in the market, then that is feasible in that market, which is the US market that we're talking about. In the Indian market, we really don't have that, and therefore it can be misused for for schemes which may not be remunerable in that sense. Yeah.
Sure, thank you. In the interest of time, I'll just take one more question, and some of the other questions we will still pass on to the panelists, and we can maybe get answers later on. There was a question on the tax treatment on angel investment capital gains. Can they be set off against capital losses in the case of angel investment failures? And that's an interesting point. I mean, first of all, what is the status with the angel tax now? There's been some suggestion that up to 10 crores of fundraise, it doesn't really apply, but it's not been formalized. Again, I'm not sure who to come to with this question. Would anyone like to take it?
I think Mr. Sandeep can answer this.
Sandeep, would you like to go with this?
Yeah, so this is a specific question. We would need to see the facts of the situation, of course, that will determine it. But generally, when it comes to the capital gains and set off of the capital gains against the capital losses, yes, there is a possibility of setting off capital gains against capital losses. But we obviously need to see what kind of capital gains have been made and what kind of capital losses have been incurred. To the extent they are relatable and it is from the same business, there is definitely possibility of setting off. Also, the nature of the gains and losses will have to be seen, whether they are long-term or short-term capital gains or long-term or short-term capital losses. The specifics, of course, will need to be looked at, and happy to kind of advise on this more specifically on the possibilities of setting it off and taking the benefits.
Thank you very much for that. In the interest of time, as we are already running a little late on our schedule, let me conclude this session here and individually thank each one of you, Dr. Jajit, Mr. Shnoy, Mr. Mukherjee, Mr. Bantia, Mr. Gopal Rao. It's been a very enlightening panel. Thank you for your answers and being a part of the panel. I think some of you have a hard stop now and need to take off. But others, I hope, will stay on till the end of the session. The next three sessions are on direct taxes for corporates, direct taxes for non-corporates, and then indirect taxes. So let's move on to that. Once again, thank you everyone for joining this panel.
Thank you very much, Denny. Thanks for the opportunity.
Thank you, Denny. Bye-bye.
Thank you, Mr. Denny.
Yes, just hold on. Let me just. So the next is a session on direct tax proposals for corporates to start with, and that will be done by Mr. Sandeep Mukherjee. I've already done the introduction. He is a tax professional, chartered accountant by profession, and has had significant experience in the industry. Over to you, Mr. Mukherjee.
Thank you, Denny. I hope my presentation is visible. I have
yes, we can see it.
Yeah. So the way we will run it is I'll take the direct tax proposals for corporates, and I'll also cover some of the other aspects related to the non-corporates. And I will ask Mr. Rao to deal with more the procedural changes, the impact from a revenue perspective, given Mr. Rao's stature as the Chief Commissioner of Income Tax, ex-Chief Commissioner. So I think from the revenue perspective, the provisions I would ask Mr. Rao to take over, and given the limited time, we will cover only the broad and the key tax proposals. Like we said, the overall impact of the budget has been one which is focused on economic recovery through investments, through self-reliance, and through inclusiveness. These are the three aspects which are very visible in all the proposals also which are there in the direct tax. We talked about many of the changes, so I'll not repeat some of them. But one thing which I think we need to understand is a very welcome move, that is the opening up of the insurance sector. That's something which has been announced, and the increase in the FDI from 49% to 74%, which is of course subject to having safeguards such as the majority of the directors of the board and the key management persons to be resident Indians, and also with 50% of directors to be independent directors, with also specified percentage of profits to be retained as general reserve. These are some conditions which have been introduced, but overall, I think opening up the insurance sector to foreign investment was something which was expected for the last few years. As you know, you're only having joint ventures in the insurance sector, so that's a very welcome move. The consolidation of the various acts, the securities acts, be it the SEBI Act, the SCRA Act, or the SI Act, all of these, the consolidation is also something which has happened, and that's a welcome again a move. A lot of major boost which is given to the financial services sector, to the health and the well-being sectors, and a lot of proposals which will create jobs. So that's our overall kind of an impact. Moving to the specific proposals, if I may. Coming to the boost to startups, because we are here talking more about the startups and the angel investors and stuff. So I thought it's important to begin with the startup related provisions. So ATIAC, which Dr. Jajit also mentioned, there's the section in the Income Tax Act which talks about the exemption from profits and gains to the eligible startups for 3 consecutive years out of 10 years at the option of the startup. So that's been extended from 1st April 21 to 1st April 22 by 1 year. Similarly, and of course, the startup turnover also Dr. Jajit mentioned is important to note that it should not exceed 100 crores. Similarly, there's a provision in the Income Tax Act in section 54 GB, which talks about the exemption from capital gains arising on transfer of long-term capital assets being a residential property if they are invested in subscribing shares of eligible startups. And the startup has to utilize that money by purchasing new assets within 1 year from the date of subscription. That's also been extended by 1 year from 31st March to 31st March 22. We talked about the one-person company. So I think that's something which we have already discussed, that it will help a lot of businesses, and as I mentioned, close to 200,000 businesses are expected to benefit out of this one person company setup. The features of that we have already discussed, so I'm not going into it again. Coming to the small companies, yes, the small companies under the Companies Act 2013, they do have very less compliances. So, anything which is done for them is definitely going to help a lot of small businesses. So the threshold for turnover, which has been increased from 2 crores to 20 crores, means a lot more companies will now be defined under the small company status. And also the threshold for paid up share capital being increased from 50 lakhs to 2 crores. So that's also going to bring in a lot of companies under this threshold. Coming to the next one, which is on the impetus which has been given to the IFSC, the GIFT City. So we have a few provisions, and a lot of them are very, very welcome provisions. India-based fund managers that operate from an IFSC in India. As you know, IFSC is currently only in Gujarat. So these fund managers can now manage monies of foreign investment funds, as opposed to only providing non-binding investment advice, which they were earlier doing for these foreign investment funds. They can do that now without creating an Indian permanent establishment, and the risk of the place of effective management, or POEM, which was there for the FIFs, that will not be there anymore. And without having also to satisfy the numerous conditions which are stipulated. As you know, there's a section 9A of the Income Tax Act, which talks about the business connection bit, but which is with a lot of conditions. So this should definitely boost the Indian asset management industry, in my view. So that's a very welcome move. Similarly, relocation of the foreign investment funds from overseas to an IFSC in India will also now be treated as tax exempt. This should, in my view, also help in onshoring more FIFs now, primarily which are India-focused funds, such as FPIs, private equity funds, from popular overseas investment fund jurisdictions. As you know, we are used to seeing Mauritius and Singapore being used as these overseas investment fund jurisdictions. Now, hopefully, with these amendments, we will see India becoming one of the more popular investment fund jurisdiction. Also, significant tax benefits are granted now to attract foreign investors to locate to IFSC. Foreign banks that invest in capital markets globally, including in the Indian capital markets under the FPI route, will now be encouraged to set up investment divisions in IFSC in India to undertake global trading activities onshore from India. So these trades could relate to the bank's proprietary positions or to client positions. So again, a welcome move, and this is something which will boost the IFSC units. There is something which is also there in the IFSC related bit, which is on aircraft leasing. So the measures which have been taken by the government to promote India as an aircraft leasing center, especially for use by Indian domestic carriers, that I think is also needs to be welcomed. This will definitely encourage aircraft lessors to set up the operations in the IFSC, and also encourage Indian domestic carriers to take aircrafts on lease from such IFSC units, as opposed to leasing aircraft directly from overseas leasing centers. Again, here we were used to seeing Ireland and China as the overseas leasing centers, especially because the favorable treaty positions which were there, the tax treaty provisions. So now going forward, hopefully India will now enter this space. Also, non-residents will benefit from the income tax exemption, which are granted to them on the income that is earned on transfer of non-deliverable forward contracts, NDFs, which are entered with banks operating out of an IFSC. So this should also help bring the overseas NDF market onshore now into the IFSC GIFT City space. Moving to the next, which is on the sovereign wealth funds and the pension funds. Again, some very welcome provisions over there. So conditions for SWF and PF to claim the exemption from infrastructure investments have now been relaxed. The amendments are proposed to be effective from financial year 2021. That's one point which I wanted to make. In this budget, you would see a lot of provisions which are made from financial year 2021. There are very few which actually are effective from the next financial year, this 21-22. So 2021 is already we are at the end of the 2021 year almost, and we have a lot of provisions which are formed to 2021. Now this creates some problems. I'll discuss that in my later slides, but it needs to be noted that many of these provisions are made from the year, which is already in the duration of the year. So the practical challenges are there, and we have to take into account all these challenges. So this is also an amendment which is effective from financial year 2021. This relates to the section 23E, 23FE, 1023FE of the Income Tax Act, and that's something which we need to bear in mind. So notified SWFs and FPFs will benefit from the rationalization of the income tax exemption provisions which are applicable to them regarding their investments in eligible infrastructure projects. And also now SWFs and FPFs will also be permitted to claim the income tax exemptions on investments which are made by them in Indian platform arrangements, like, for example, NBFCs, IFCs, IDFs, Category 1 and Category 2 AIFs that invest in at least 50% eligible infrastructure projects, as well as in InvITs. So I think overall, a lot of focus on the infrastructure sector through these provisions. Moving to the next one, which is on the affordable housing and affordable rental housing. So that's basically the 80IBA of the Act. And now rental housing projects have to be notified on or before 31st of March 22, and they need to fulfill the notified conditions. So this was more from the migrant laborers perspective and help that they needed. So rental housing project is something which has been added to the affordable housing which was already there. And as you know, under section 248 of the Act, there is this definition when it comes to the infrastructure debt funds and zero coupon bonds. So section 248 of the Income Tax Act defines the zero coupon bond, and that is now proposed to be modified to include bonds which are issued by an infrastructure debt fund. Such bonds have to be notified, of course, and there is a rule 2F and 8B of the rules which will now be amended consequentially and effective from 22-23 assessment year. So this is the one where again it is from 21-22 now financial year. So this has to be noted. Investors in notified infrastructure debt funds will now benefit from the capital gains treatment on investments which are made in these zero coupon bonds issued by such IDFs. And this will definitely again boost the IDFs and the infrastructure sector. Moving to the next one, which is on the equalization levy. Again, a very interesting kind of a development which has happened over here. As you know, an equalization levy was already upon us since the last four years. 2016 was when it was introduced, and India was one among the first countries to introduce this levy in this form. So there are some clarifications which have been introduced. There are some provisions which have been introduced which will help. So the three things which have happened: one is the clarification on the e-commerce supply or services definition itself. So some of these activities are also now covered. Also, it has been clarified that irrespective of whether the e-commerce operator owns the goods or provides or facilitates the services, it would still apply. And lastly, and most importantly, there was this overlap between royalty and fees for technical services, which could also fall within the levy of equalization levy. So that's been clarified that if it is fees for technical services or royalty, that will be outside the scope of equalization levy. I think this is something which needs to be properly delved into by each and every operator who is in this space, because equalization levy is already upon us. These are clarifications which have again come from 2021, and equalization levy, as you know, is at 2% as compared to royalty and technical service fees, where the rate is at 10%. So planning opportunities exist, and this is something where the applicability has to be properly analyzed by I think all businesses. So I'll move to the next one, which is on the TDS and TCS provisions. So TDS on dividend paid to business trust, as you know, section 194 of the Income Tax Act covers that. And there is an amendment in that act in the second proviso, which says that with a view to ease the compliance and resolve the liquidity and cash flow issue, TDS exemption is provided on distribution of dividend to business trust through SPVs in whose hand dividend is going to be exempt. So this is effective again from 1st April 2020. Again, an amendment which is already in vogue now, in force. Similarly, 196D section, Indian corporates will now be able to apply the tax rate, the DTA rates, while withholding tax on dividends and interest which are paid to FPIs. This was something which was represented by the FPIs very strongly to the finance minister, and it has been heard. So this will benefit FPIs as they now they need not have to deal with the issue of surplus withholding tax in India on Indian sourced dividends. This is effective from 1st of April 21. There's a section 206AB which has been introduced, higher TDS for non-filers. Similarly, a 206 CCA section higher TCS for non-filers, and this is effective from 1st of July 2021. I think this is one of the provisions which I call as practically difficult and complex to comply with. We'll talk about this if time permits later, but this is one of the provisions which I feel is going to be difficult as to how do you actually understand and know who is a non-filer, and on that basis the onus has been given to the deductor to deduct a higher tax. Similarly, TCS on sale of goods effectively has replaced with TDS on purchase of goods. So we already had the TCS. Now the TCS continues, but effective 1st July 2021, we will also have a new section 194Q. So both 206C 1H, which is a section of TCS, and section 194Q, which is a new section, both of them will now coexist. And though the memorandum does say that wherever there is a situation where both are applying, then 194Q will supersede 206C 1H. So TDS will supersede TCS. However, again, a very practical difficulty kind of a section, which will lead to a lot of litigation, I'm sure, as to when do you apply 206C, when do you apply 194Q. Also, these are things which will need to be dealt with as we move ahead. Coming to the capital gains provisions, the big one is on depreciation of goodwill. Presently, as you know, depreciation is allowed on goodwill on the basis of the decision which was announced by the Supreme Court in the case of Smes securities. And we were going by that decision and allowing goodwill and treating goodwill as a depreciable asset. But in order to override the said decision, there have been some amendments which have been now made in the finance bill, which is saying that goodwill forms part of an asset block on which tax depreciation will, if it has been claimed, the asset blocks WDV and the short-term capital gain on goodwill will be determined in the manner to be prescribed. So in a manner to be prescribed means that we should expect guidelines, and definitely this will need some guidelines, because there are a lot of, again, complications which will come into, especially goodwill, if it is a part of the block, how do you take it out of the block, etc., etc. And this is again effective from 2021 financial year, already upon us, and 3 installments of advance tax have already been paid. Practical difficulties, practical challenges, how do you calculate tax, whether interest will apply, 234B, 234C, all of these are practical challenges. At the same time, there is an anomaly in the amendment itself. So the act, if you see the finance bill in section 50, talks about it as effective from assessment year 2021, which goes back to financial year 1920. And otherwise in the memorandum, it talks about financial year 2021-22. So, I mean, whether it is assessment year 21-22 or assessment year 2021, these are things which will need to be clarified. I'm sure that's something which will come out in the Finance Act when it is passed. On slum sale, the Honorable Bombay High Court had, in the case of Bharat Bijli, held that provision of section 50B applies only to the sale for a monetary consideration and not to a case of exchange of the undertaking for any other assets. So this was again a loophole in a way, and that has been clarified that no transaction involving slump exchange which were outside the provisions of 50B will now no longer be outside, and that is the clarity that has come that it is also going to be treated as a slump sale. As far as the individuals are concerned, not a lot of changes, but a couple of them which I think need to be looked at. One is from a senior citizen's perspective. So we already had senior citizen above 60 and super senior citizen above 80. And now we have another category who are above 75, earning pension and interest income from specified bank in which they are receiving pension. They are now going to be exempt from filing the return of income subject to conditions. This subject to conditions, I think, is a very important part over here. There are a lot of conditions and again a lot of practical difficulties which will come in. In the interest of time, I'm not getting into the details, but you can understand that it is not going to be easy for every senior citizen to claim this, because there are a lot of conditions which need to be fulfilled. Only then it will be allowed. And again, the onus is now on the specified bank to, in a way, compute the taxes of the senior citizen, which to my mind is also a practical challenge. Tax exemption for the cash allowance in lieu of LTC. This was already announced, as you know, during the COVID, the pandemic itself. So we have basically got this enacted now in the Act itself, and the conditions are very similar to what we have already understood this. The one on extension, the extending of the date of the sanction of loan, that's section 80 EEA. Interest on housing loan, that's a welcome move. Then section 1011 of the Income Tax Act, which is amended because of the exemption of PF interest This is effective from assessment year 22-23. This again is something which is going to cause some practical challenges. There are already murmurs that, does it apply to the corpus?
Mr. Mukherjee, can I request you to kind of conclude, because I think some of these individual measures anyway will be coming in the next one also.
Yeah,
right?
yeah. So I can just rush through this and coming to the business income, there's really no change in the tax rate, so not much to talk about from the employee. Only one is the one on the disallowance of the employee contribution to PF. I think that's a penal kind of a provision, so we should make sure that there is no delay in that, and the amendment proposed in the MAT computation. So I'll not take these in detail. I will now request Mr. Rao to take the remaining slides. The ease of doing business part is something which we have already discussed, so I'm not getting into that. So now I request Mr. Rao to take the remaining slides, which are more on the procedural and compliance aspects. Thank you.
Thank you. Mr. Rao, you need to unmute yourself. You're on mute. Yes.
Thank you, Mr. Sandeep. And anyway, because there is a limitation of time, I will just briefly mention some of the procedural aspects. And many of you may know the FAS, the Faceless Assessment Scheme that has been introduced, this year by the Government of India in the Income Tax Department. Similarly, Faceless Assessment Scheme also, that is also introduced this year in the Income Tax Department. And seeing the success and the response from the all the stakeholders, the government thought of introducing the faceless appeals to at the level of the Income Tax Appellate Tribunal. As you know, Income Tax Appellate Tribunal is the second appellate authority, and it is the final fact-finding authority. Anybody aggrieved by this order, either by the department or the taxpayer, they can go to the High Court. This, a very, very important, very bold initiative, but there are certain reservations, and people are not welcoming this feature, since it being the final fact-finding authority, and whether the taxpayers get the reasonable opportunity of hearing, adi alteram partem, that is a judicial principle, whether this can be followed properly or not, whether they are heard, in this in the digital era through video meetings, and many people are, very critical about these things. We don't know what is the government reaction, but the government decided to go ahead with this faceless assessment scheme. As you know, this faceless assessment scheme and faceless appellate scheme was introduced last year, and there are 4 or 5 points which I would like to mention that. And there is a criticism about the Income Tax Department, that department using the powers arbitrarily and selectively, and using favoritism. There is a scope for a lot of corruption, and these are the general criticism against the regular on the assessment scheme, where the taxpayer is asked to run around the department. Because of these things, the faceless assessment scheme has been introduced. On the same lines, the faceless ITIT scheme is also being introduced. Let us see how it works. And there are some other changes. Very important change is the dispute resolution committees, where the taxable income is below 50 lakhs and the disputed income is 10 lakhs rupees. The taxpayer can file an application to the dispute resolution committee. The dispute resolution committee will hear both sides and will pass orders, and in suitable cases, they can reduce the penalty, waive the penalty. Similarly, they can reduce and waive these prosecution provisions. This is a very, very important provision, and it is binding on the taxpayer, and small taxpayers, this is a very welcome change, and people have received it in a positive way, this particular step. And there are 2-3 other things which I just touch it upon. The Income Tax Settlement Commission was established long back for settling the cases where there is a department is not agreeing, where there are difficulties in explaining to the department because of the evidentiary value or whatever may be specular nature of the cases. The taxpayer can go to the Settlement Commission. The Settlement Commission will hear the parties and pass an order that is binding on them. But this has given scope for, again, a lot of litigation. People are not accepting the order of the Settlement Commission. They are filing writ appeal before the High Court. the desired purpose is not served. That's why the settlement commission is being abolished. And there is also another change, important change is authority for advanced ruling. This authority for advanced ruling consists of Supreme Court and High Court judges and one technical member from the department. And this advanced ruling is basically for many people who wants to know the taxability position in advance, whether a particular issue is taxable in India or not, what are the benefits. They can get a finding from the AAR. But again, this authority also has some limitations again. There is lack of suitable judges for the appointment. And again, the order is binding on both the department and the taxpayer, but people are not accepting the order. Again, similarly, like settlement commission, people are going on writ appeal to the High Court when the desired purpose is not served. That's why they changed the constitution of this authority for advanced ruling into board for advanced ruling. The board for advanced ruling consists of 2 chief commissioner level officers, and they will hear both the parties and issue the order. The order is appealable. Earlier, the order was binding, and now this order is appealable to the High Court. That is a change in the board for advanced ruling. And there are certain other provisions for search and seizure. Earlier, olden days, there was a block assessment scheme. Whenever a particular taxpayer is raided under Section 132 of the Income Tax Act, there was a separate search and seizure assessment procedure that was known as a block assessment scheme. 10 years were reopened and assessments were completed based on the evidence. But that was replaced by a new system where only 6 years were reopened and examined and assessment orders was passed. And this system also did not serve the desired purpose. Then now government is abolished that system also. They have come back to the old system where the assessments will be reopened based on the information in the possession of the department. If the AO has information in his possession, he can reopen the assessment up to the 10 years. So in the search and seizure cases, and the reopening period has been reduced to 3 years. Of course, this is again subject to the income escaping assessment is 50 lakhs or more. If it is below 50 lakhs, the limit is reduced to 3 years. It is a big relief to the taxpayers. There is kind of a certainty for the assessments. If the SSC's accounts are correct, the taxpayer is maintained his things properly. He doesn't need to worry about the department. He can happily sleep. And where there are manipulations, 50 lakhs and above, the department can go up to the 10 years. That is a very important thing. This reopening of assessments and search and seizure assessments, some of the very, very important changes which were brought in the Income Tax Act. And I will touch upon the last point. That is again, because of there is a lot of digital transformation of the department and things are available, everything on the electronic mode. The time limits for making assessments have been reduced. Filing of revised returns also has been reduced. The details I don't want to discuss now. It is again little confusing. We can share the PPT. People who want, they can just go through it. These are some procedural changes which I wanted to share with you. If there are any questions on this, I am ready to answer.
Yeah, thank you, Mr. Rao. Maybe we will take the questions after the next presentation also. If Mr. Bhatia, if you can take us through the indirect tax proposals. We can then come back to the Q&A if you have questions on any of these talks.
Okay. Yeah.
I'll run the presentation. Pramod,
okay.
I can run the presentation. Please go ahead.
Sure. Yeah. Okay. Yeah. Thank you. So I'll quickly run through the amendments in the indirect taxes, which includes GST, customs, and CST. On GST front, the amendments have been incorporated in the definition of supply, which would now require the clubs and associations to pay tax on supply of goods and services to its members. The only negative part here is that this provision has been made effective retrospective, which means from 1st of July 2017, these provisions would be made into force. I think the reason why these amendments have been made is there was a lot of disputes going on between the government and the clubs that clubs are not subject to tax because the clubs and the members are not two different persons. based on the doctrine of mutuality, the Supreme Court has actually also held in favor of club that they are not subject to indirect taxations. But to overcome all those rulings and disputes or doubts, government has now introduced some changes whereby the club will be taxable. With regard to zero-rated supply, there are a few changes which has been incorporated. In fact, these are more restrictions in nature. So benefit of zero-rated supply of goods to ACZ and developers so far was without any conditions. So all supplies to ACZ unit or developers were subject to zero-rated, which means there was no GST on supplies to these specific sector. Now the condition has been incorporated to say that the only goods which are used for authorized operation will be subject to exemption. Otherwise, GST will be leviable on the said increase compliance for ACC and also to certain extent cash flow issue. With regard to other options, zero-rated supply, there were two options to file the refunds, either refunds of unutilized input tax credit or utilize that credit to pay the IGST on exports and claim refund of the IGST. The second options have been discontinued. The only options now is to file the refund claim with regard to unutilized input tax credit. And the other option is now subject to notified. The board will notify the class of taxpayers or the class of goods or services which will be subject to the other options of payment of IGST and refund thereof. I think this is a big. This is not a positive proposal. I think this will definitely have a cash flow impact, and the credit with regard to capital goods will be blocked because refund of input tax credit doesn't allow refund of tax paid on capital goods. It is only for inputs and input services. So clearly, this is a challenge. The third, the export, the zero-rated supply export, the condition is that the recovery has to be proved that the sale proceeds have been received in foreign exchange. In the absence of showing that there was a receipt, the refunds have to return back to the tax department along with interest. The other, these are all, I think, compliance driven, that there are the net the interest is now payable on the net payment basis. Earlier it was on, now it will be on net tax, which means after set off of the input tax credit, and it is effective from 1st of July 17. And self-assessment tax definition has been broad-based now. Earlier, the definition was that if you filed a GSTR 1 and GSTR 3, thereby you actually do a self-assessment of your tax. The same has to be recovered without any adjudications. Now, the law has been amended to say that if you have filed your GSTR 1 only, even then that will qualify as a self-assessment tax, and recovery can be initiated without any adjudication or proceedings. Commissioner can now order for provisional assessment, provisional attachment of properties, including bank account, and this order will be passed at the time of initiation of the proceedings under the law. As against previously, it was during the pendency of the proceedings. Upfront payment of 25% of the penalty has to be made in order to be eligible for filing the appeal now under the law. Input tax credit, there is additional conditions which has been incorporated now, which is that the supplier has to upload the information with regard to the invoices and debit notes on GSTR 1, and it should be it should appear in GSTR 2A or 2B of the recipient of the goods or services. Only in that situations the credit on or input tax credit will be allowed. This provision was there with regard to matching concept in Rule 34. However, there was no statutory provisions with regard to that. This, in fact, tries to bring in that statutory power to ensure matching concept. Annual returns, very positive development, and it will certainly be a good news for the startups. There is no requirement to file the to get the reconciliation statement certified by chartered accountants or cost accountant. It can be self-certified and can be filed along with the annual returns. On customs front, I think there are some trade facilitations measures. Just like in GST, the common portal has been quite successful in terms of interactions with the between the trade and the department. Similar, portal will now be introduced in customs, whereby the day-to-day operations like filing of bill of entry, shipping bills, payment of tax, service of notice, orders, everything will be on the portal, and there will be less of interactions with the tax authority. Bill of entry has to be now filed 1 day in advance, means the previous day of the arrival of the goods. This is a welcome measures. This is called advance filing of bill of entry. In search and seizure case, the time limit of 2 years have been specified, that the whole proceedings have to complete in 2 years' time, and it should culminate into a show cause notice under Section 28. So the search, seizures, investigations cannot be open-ended. So these 2 years have been, and it can be extended just 1 year by the commissioner. 351 amendments of the existing tariff has been proposed in order to, bring it in line with HSN 22. This is more of a rationalization. 2 year sunset clause. This is very important. All the conditional exemptions now will have a 2-year clause. It will expire after 2 years unless it is extended by the government. The existing conditional notification will come to an end on 31st March 2023. There are 400 odd redundant obsolete exemption notifications which are being reviewed by the customs authority, by the government, and the review will be complete by October this year. On customs front, I think these are two stringent, very stringent provisions which has been introduced, that if there is any refund, a wrongful claim of refund or remissions by the exporters, the export goods can be confiscated. Also, the penalty could be 5 times of the refund that has been claimed on export goods. Going to the next slides, I think these are some changes in the customs duty rate. I'll not go into details about this, but largely it is the rates have been increased. I think the reason behind is that the government intends to encourage a lot more manufacturing in India and discourage import of parts and components. So move towards localization of manufacturing of electronic and other parts. As far as agriculture infrastructure is concerned, as this is a new levy which is levied on certain specified imported goods and locally manufactured petrol and diesel. The value will be calculated on the value on the CIF value of the goods, just like basic customs duty. This fund is normally going to be used for improvement of agriculture and other related development expenditure. The rates again varies from product to product, 1.5% on coal to 100% on alcoholic beverages. Moving to next slide. I think social welfare is exempt on gold and silver, on the value of the AIDC imposed on gold and silver. AIDC will not apply where the basic customs duty is 0. Just like under advanced ruling, EOU and FTAs, there are no basic customs duty. They are exempt, and hence AIDC will not be levied. Certainly, this will have a marginal increase in the cost of import in some cases. However, the government has reduced the basic customs duty to commensurate the levy of AIDC so that the impact is low. On central sales tax, there is this one significant amendment which has been done. Currently, petroleum, diesel, petrol, natural gas, and alcoholic beverages are not covered under GST. They are currently a part of the central sales tax and VAT regime. There is a feature of concession rate of Cfo in case of interstate purchase or sale. This is being, can be used for resale of goods, purchase of goods for resale, or purchase of goods for manufacture of goods, or for in specified circumstances. Now the changes proposed is that the 2% benefit is only available to products which are part of the CST law. Petroleum, diesel, natural gas will only be entitled to claim concession rate of Cfo of 2%, which is in fact significant modifications to CST law. That's all, I guess, from my side on the indirect tax.
Thank you.
Happy
Thank
to take
you.
questions if there is
Thank
any.
you, Mr. Bhantia. Yes, we can just take a couple of questions if there are on any of the tax proposals, and I do have one already. This is again going back to the angel tax provision. And the question is, can long-term capital gains be set aside, set against capital losses, and what documentation do failed startups need to provide to make this possible?
Yeah, so I think we have answered that question earlier. Denny, you want me to answer that again?
So I think it was a follow-up question. What is the documentation required by failed startups to make sure that you get credit for the capital losses? Would you?
Yeah, so those again would be the specific kind of documents which would be looked into by the by the department also, as to what is the nature of the loss, whether it's long-term or short-term, and what from what business this loss has kind of been incurred. So
yeah. So I guess one question here would be, how do you establish that a loss has occurred? If it is a public market, you are selling the share, and therefore there is a clear loss or gain. Whereas in the private, whereas in this case, the company may just wind up and go. There is no sale happening.
Exactly.
So you need some documentation to show that there is actually a loss that has taken place.
Yeah, and given that today we are in a situation where you no longer have the opportunity to have a in-person kind of a discussion with your tax officer.
That's right.
Everything is now faceless.
Yes.
So it would be very important to ensure that the documentation that you are producing is complete and it is robust and it meets the requirements of the tax department.
So the question, I mean, again, going back to that, the question was, is there something the startup will have to file as documentation, or what is the documentation one can have?
So this, the documentation is not required to be filed at the time of filing of the tax return.
Okay.
If you are making a claim of a set-off,
right,
then your tax return does not provide you the opportunity to provide any documentation at that stage. The documentation will come at a later stage when the assessment is in process. And most likely in a situation where you have claimed this kind of a set-off, your case is likely to be taken up for a scrutiny. And given that in a faceless assessment and faceless situation, you do not know who is your assessing officer. So you will get a notice, you will have to at that point in time produce the documents which are asked for. So these are the practical challenges which happens, especially in these kind of situations.
Right.
Earlier you could talk to your tax officer, and Mr. Gopal Rao is somebody who can give you the practical side of it as to how it was easier for the assessing officer to get the necessary explanation and documentation and close the case.
Close the case. Yeah,
now this will go through long rounds of interactions between the SSCA, the assessment center, and the rectification center, and so many other centers which have been the technical center, all these centers which are all faceless. And the hapless SSC has to deal with all these centers and respond to all these messages.
Sure. So Chand, has that answered your question? Since if you're still there, I'm not sure if Chand can speak as an attendee. Maybe he's not able to. So that was the only question that was there, and as we've already taken quite a bit of extra time than our scheduled time, let me once again thank all the panelists, Mr. Rao, Mr. Mukherjee, Mr. Bhantia, for taking us through the details. That was quite exhaustive. And I'm sure there could be still other points we could have covered, but in the interest of time, we couldn't attend to all of that. And I would take the liberty of saying that this presentation that you made will be available to those who would like to have a look at it.
Sure.
And also that if any of them have more specific questions, they will be welcome to reach out to you through Fox Mandal.
Absolutely.
And we can take some of these questions again. So once again, thank you very much for joining us. And let me also thank all the attendees. If you would like to know more about Fox Mandal, which is a law firm, or Keiretsu Forum, which is an angel investment network, again, do get in touch with us. We'll be happy to take you through that individually, as also, as I mentioned, on any of these tax proposals.
Thank you so much. Thank you for this opportunity, Denny. Thank you.
Thank you very much. Thank you. Thank you.
Thank you. Thanks, Denny. Yeah.
Yeah.
Bye-bye.
Going to end the session. See you all the next time.
Thank you. Bye-bye.